Welcome to Griffonomics.
Glad to be here for this one. It's quite a story.
It really is. I mean, imagine waking up tomorrow and buying a company that is, 200 times your size. Not a merger of equals, not some strategic partnership. Just a complete, unadulterated buyout.
Right. A total takeover.
Exactly. Today, we are looking at a $56 million software consultancy that literally woke up one morning and swallowed a $10.6 billion industrial giant. And that was, remarkably, only step one of a $50 billion roadmap.
Yeah, it's wild. You look at the company's balance sheet one day and it's this tiny tech firm. And then you look at it the next day and it is a $10 billion industrial behemoth, actively hunting for more targets.
It's completely engineered. So our mission for this deep dive is to unpack a massive stack of sources we've gathered. I mean, we've got an incredibly dense 2025 Form 10-K.
Very dense.
Yeah, super dense. Plus this highly structured, almost labyrinthine Apollo investment agreement and several strategic market analyses. We're going to use all of these to understand the phenomenal, almost unbelievable transformation of this company, QXO.
Right, because this kind of transformation doesn't just happen organically, right? It doesn't take decades. It's manufactured in boardrooms and executed through these incredibly complex legal and financial structures.
Totally. And if you are tuning in, you probably already understand the basics of M&A. But if you've ever wondered how Wall Street titans engineer these massive industry consolidations down to the absolute granular details, like, the tax code and the debt covenants, this is the deep dive for you.
Oh, absolutely. What QXO has done over the past year is just a masterclass in capital allocation.
We are going to look under the hood of all of it. The financial engineering, the strategic deployment of artificial intelligence right down at the warehouse level, and just the sheer audacity of targeting $50 billion in annual revenue within a decade.
Which is a huge number.
Okay, let's unpack this. Before we get into how QXO is executing this master plan, we need to understand the playground they've decided to operate in, right?
Yeah, you don't build a $50 billion company in some niche market.
Right. You need a massive sandbox, and this sandbox is the building products distribution market.
And that market, the fundamental thesis of QXO's entire strategy rests on the macroeconomics of this specific industry. According to the analyses we have, it generated roughly $800 billion globally in 2024.
$800 billion, that's massive.
It is. And it's split almost evenly between North America and Western Europe. But the sheer aggregate size isn't really the primary catalyst for a roll-up strategy like this.
Yeah, so what is?
It's the composition of that revenue. That's what makes this market uniquely attractive to an aggressive consolidator. We're looking at a revenue stream that is overwhelmingly insulated from consumer sentiment.
Right, because the natural assumption when you look at building products is to visualize, new housing starts. You look at the lumber, the roofing, the siding, and you think about subdivisions springing up, which makes you think the industry is just hypersensitive to the Federal Reserve and mortgage rates.
Sure, that's what everyone assumes. But the documents paint a totally inverted picture. The data actually shows that 80% of this industry's revenue comes from R&R.
Repair and re-roofing.
Right. Only 20% is tied to new construction. 80% of an $800 billion market is literally just fixing what is already deteriorating.
Wow, just fixing broken stuff.
Exactly. And of that 80%, 94% is classified as non-discretionary.
Wait, 94%?
94%. If we connect this to the bigger picture, this forms a massive, almost impenetrable defensive moat around the industry. We are talking about the basic physical maintenance of civilization.
I guess that makes sense. It's like the plumbing of the economy.
Right. When a commercial flat roof in Chicago begins to fail, or, hail degrades the asphalt shingles on a residential block in Texas, the building owner can't just sit on their hands.
Right. They can't wait for a more favorable macroeconomic environment to fix a leak.
Exactly. The degradation of the building envelope forces immediate capital expenditure. Water intrusion destroys structural integrity, it ruins inventory, and creates massive liability.
It's completely unglamorous. You don't look at a pallet of oriented strand board or a roll of waterproofing membrane and think about high finance innovation.
Not at all.
But it's catastrophic if you ignore it, and therefore incredibly lucrative for whoever controls those distribution nodes. The demand is structurally guaranteed by just the passage of time and the unavoidable forces of nature.
And the sources lay out these macro tailwinds perfectly. The average U.S. single-family home is currently over 40 years old.
40 years old.
Yeah. And the average non-residential structure, so meaning commercial buildings, retail spaces, warehouses, is over 50 years old. So we're looking at this massive aging installed base that requires continuous, unavoidable maintenance just to remain functional.
Just to not fall apart.
Right. And the baseline degradation curve of a 40-year-old asset is steep enough. But then you layer environmental volatility directly on top of it.
Yeah.
The strategic market analysis notes that severe weather events have actually quadrupled in frequency over the last 20 years.
Quadrupled. That's insane.
And they've doubled in their economic impact. Every major storm cell, every significant hail event, every deep freeze, these are immediate catalysts for non-discretionary repair and re-roofing spend.
So in a purely financial sense, the weather is acting as a massive, unsolicited demand generator.
That's a great way to put it. It forces the transaction.
And it's not just the immediate damage either. The documents show that regulatory and insurance mandates are actually forcing building owners to invest in preventative restoration, like long before a catastrophic failure even occurs.
Oh yeah, commercial property insurance premiums have skyrocketed. Insurers are actively mandating roof replacements and structural waterproofing upgrades as a condition of continued coverage.
So if you want to keep your commercial real estate insured and compliant, you maintain the weather envelope.
Exactly. And that dynamic ensures a steady, multi-decade pipeline of demand that really doesn't care if the S&P 500's up or down.
Which is an incredible moat. But we also have to account for the remaining 20%, right? The new construction segment.
Right, and the tailwinds there are mathematically documented too. There is a domestic housing shortage of approximately 4 million units in the United States.
4 million.
Yeah, and at current building rates, considering zoning friction, labor shortages, and land acquisition delays, that represents an 8-year backlog of construction demand merely to reach equilibrium.
Just to catch up to zero.
Just to catch up. And on the public and commercial side, there's a projected $2 trillion in infrastructure spending needed over the next 2 decades in North America alone, just to keep existing infrastructure safe and operational.
Okay, so $2 trillion in infrastructure, 4 million homes short, aging housing stock, and quadrupling weather events. When you lay out the aggregate demand, it sounds like an entirely bulletproof ecosystem.
It's extremely robust.
But the glaring inefficiency that jumped out at me from the sources is the structure of the supply side. Because if this market is an $800 billion behemoth with, structurally guaranteed demand, it should logically be dominated by 3 or 4 mega corporations operating in an oligopoly, right?
Like aerospace or telecommunications.
Exactly. Instead, we have this hyper-fragmented landscape.
Yeah, the building products distribution industry is historically incredibly fragmented. And that fragmentation is the core thesis of QXO's existence. The sources indicate there are over 7,000 distinct distributors in North America alone.
7,000.
And roughly 13,000 in Europe. If you isolate just the roofing sector, approximately 30% of the market is held by over 500 small, independent, locally competitive dealers.
500 in just roofing. I mean, I'm pretty sure my uncle actually operates one of those independent dealers.
Really?
Yeah. And his inventory management system is literally just a clipboard from 1998 and a gut feeling about what the local contractors might need next Tuesday.
Yeah, exactly, the clipboard system. But 500 independent dealers in roofing alone means the supply chain is completely riddled with friction.
And fragmentation on that scale in a heavy, capital-intensive industry represents an enormous margin opportunity for an aggregator.
Massive. Because in distribution, scale provides immense structural advantages. Think about your uncle's single-branch independent dealer. They face a severe disadvantage at the negotiating table.
Oh, for sure.
They have to purchase their materials from these massive manufacturers, companies like Owens Corning, GAF, or Carlisle, and the local dealer has zero leverage to demand favorable pricing or volume rebates or, priority allocation during supply chain crunches.
Right. They basically just buy 10 pallets of shingles at whatever price the manufacturer dictates. They have no say.
Exactly. But if you own 600 branches across 50 states, your purchasing power fundamentally alters the dynamic. You aren't just a customer anymore. You are a vital distribution artery for that manufacturer.
You can negotiate aggressive volume incentive rebates.
Right. And because your blended cost of goods sold is substantially lower, you can pass a fraction of those savings onto the local contractor, which undercuts the mom-and-pop competitor down the street while simultaneously expanding your own operating margin.
Which is brilliant, and I'm guessing technology forms the second, equally critical pillar of that scale.
Oh, without a doubt. The independent dealer operating on basic spreadsheets or legacy on-premise software does not have the free cash flow to invest in enterprise-grade logistics or API integrations or digital customer portals.
Right, those cost millions.
But a massive aggregator spreads that multi-million-dollar cost of a technological overhaul across billions of dollars in revenue. So the combination of purchasing power and technological superiority creates what the industry refers to as the virtuous cycle of distribution consolidation.
The virtuous cycle, and the mechanics of that are just relentless, aren't they?
Completely relentless.
The aggregator buys up the smaller shops, which instantly increases their aggregate purchasing volume. That higher volume unlocks deeper manufacturer discounts and larger rebate checks. Right.
And then those improved margins generate excess free cash flow, which is then deployed to acquire even more independent branches and fund even more sophisticated logistics software.
It feeds itself. The fixed corporate costs, so the executive team, the central IT infrastructure, the HR and legal departments, they all get leveraged over a continually expanding revenue base.
So the operating leverage just expands continuously as the roll-up accelerates.
Exactly.
But wait, to execute a roll-up of this magnitude, you can't just buy 500 mom-and-pop shops one by one, starting from zero. How does a company actually go about eating up a fragmented market like that?
You can't. The sheer administrative friction, the legal due diligence, the ERP migrations, the cultural integration of buying single branches would completely crush a company before it ever achieved that critical mass of scale.
So you need a head start.
You cannot build a $50 billion empire by acquiring $5 million businesses one at a time from a standing start. You need a massive anchor platform.
An anchor. You require a center of gravity that already possesses the national infrastructure, the entrenched vendor relationships, and the logistical footprint to absorb those smaller, bolt-on acquisitions efficiently. You need a machine that is already running at scale.
Which brings us to this strategic inflection point of April 2025. Because before April 2025, QXO was not an industrial giant.
Not even close.
If you read the early parts of the 2025 Form 10K, they were a totally different entity known as Silversun Technologies.
Yes, a technology solutions and professional services company.
Right, providing software applications, consulting, and technical support to small and mid-sized companies. Their full-year net sales for 2024 was just $56.9 million.
Which in the context of Wall Street, a $50 million firm is microscopic. It's barely a rounding error.
It's nothing. And then they execute a transaction that completely short-circuits the traditional timeline of corporate growth.
Yeah, on April 29, 2025, QXO closed the acquisition of Beacon Roofing Supply. The purchase price was $10.6 billion, executed at $124.35 per share of Beacon's common stock.
A company doing $56 million in revenue swallowed a company valued at $10.6 billion. It is the absolute definition of a reverse merger-esque transformation, right? They utilize the public shell and the equity of the smaller entity to ingest the massive operational footprint of the larger one.
That's exactly what they did. Overnight, QXO went from a niche software consultancy to the largest publicly traded distributor of roofing, waterproofing, and complementary building products in North America.
That is just wild. And the assets acquired in that transaction represent the anchor platform we were just talking about.
Oh, absolutely. They acquired 95 years of continuous operating history. They absorbed a network of 600 branches spread across all 50 U.S. states and 7 Canadian provinces.
Wow.
And they acquired an active, heavily entrenched customer base of over 110,000 residential and non-residential contractors.
And the financial result of that was immediate, obviously. The 10K shows that QXO's net sales rocketed to $6.84 billion for the year, ended December 31st, 2025.
And crucially, that $6.84 billion only represents the post-acquisition portion of the year. So just from April 29 to the end of December.
Right. It's not even a full 12 months of Beacon's normalized historical revenue.
Not even a full year.
Here's where it gets really interesting. Because the actual mechanics of a microscopic company buying a $10 billion giant requires an astronomical level of financial engineering.
You don't just tap a revolving credit facility for $10 billion.
Right. The 10K details the sheer complexity of the share conversion and the capital stack reorganization. In connection with the acquisition, all of Beacon's outstanding common stock was canceled.
Yep.
They utilized a 9.8380 equity award exchange ratio to convert the outstanding Beacon stock-based incentive awards into replacement QXO instruments. And they had to settle the massive cash component of the deal, paying out the $124.35 per share to the existing Beacon shareholders.
Furthermore, they had to entirely restructure Beacon's existing legacy debt.
Which was huge, right?
Massive. The transaction required the settlement of a $1.26 billion senior secured term loan, $1.25 billion in senior secured notes, and hundreds of millions in outstanding line of credit borrowings. They even incurred a $37.8 million breakage fee strictly for the early termination of Beacon's debt.
A nearly $38 million penalty just to clear the old debt off the books.
Just to get a clean slate.
I mean, in the world of syndicated loans and private credit, those make-whole call provisions and early termination fees are ironclad. The bondholders and lenders built those covenants to ensure their yield, and QXO had to write a massive check just to sweep the capital structure clean so they could install their own.
Exactly. This completely altered QXO's balance sheet. They bought the ultimate platform to execute their $50 billion vision, but the Beacon acquisition was really only the opening move.
Just step one. Because to execute a $50 billion revenue vision, you can't just stop there. To keep hunting, to aggressively consolidate the rest of that fragmented market, they needed a capital structure built for prolonged warfare.
You can't pay back a multi-billion-dollar debt load and fund massive mega mergers simultaneously without structural reinforcements.
Right.
Executing a buy-and-build strategy at this velocity requires continuous, unimpeded access to billions of dollars in dry powder.
Right. You can't rely exclusively on the organic free cash flow generated by the operational business, regardless of how profitable it is.
No. The sheer scale of the M&A pipeline necessitates external leverage. By the end of 2025, the 10-K indicates QXO was managing $3.10 billion in outstanding debt.
Over $3 billion.
Yeah, and the two primary tranches of this obligation were $2.25 billion and 6.75% senior secured notes due in 2032 and an $850 million term loan facility.
So carrying $2.25 billion in senior secured notes at a 6.75% coupon rate that generates a massive interest burden.
It's heavy. The 10-K explicitly notes the severe impact on their income statement. Their net interest expense for 2025 was a negative $47.7 million.
Wow. Which is a sharp and total reversal from the previous year when the legacy software company actually generated positive interest income.
Exactly. And the senior secured designation is critical here. In the event of a default, these bondholders have first priority liens on substantially all of the assets of the issuer and the subsidiary guarantors.
Though explicitly excluding the inventory and receivables, right, which are carved out to secure their asset-based lending facility.
Right. But it is heavily collateralized debt, utilizing the physical footprint of the 600 Beacon branches, the rolling stock, the real estate, the equipment as the backstop.
So they've got this massive debt load. But debt alone, particularly in a volatile interest rate environment, is insufficient to fund a $50 billion consolidation roadmap.
You must deploy equity capital as well to balance the leverage ratios. In January 2026, QXO issued 31.6 million shares of common stock in an underwritten public offering at $23.8 per share.
Which raised, what, like $750 million?
$749.4 million in net proceeds after deducting offering costs, yeah.
Okay, raising $750 million via a secondary offering is a significant capital event. But honestly, it's ultimately just working capital compared to the massive financial catalyst that occurred simultaneously.
The Apollo deal.
The Apollo lever. This is the mechanism that completely validates the sheer scale of their ambition. In January 2026, they executed an investment agreement with AP Quince Holdings, LP, which is a fund managed by affiliates of Apollo Global Management.
Right. And when one of the largest and most sophisticated alternative asset managers on the planet structures a dedicated capital vehicle for your roll-up, the market understands exactly what is happening.
Apollo committed up to $3.0 billion to purchase a newly created series of Series C convertible perpetual preferred stock.
But this capital is heavily ring-fenced.
Yes, the agreement stipulates that the funds are strictly earmarked for what they call qualifying acquisitions.
Right, and the legal definition of a qualifying acquisition in this covenant is one or more acquisitions of assets, equity, or businesses for a purchase price strictly in excess of $1.5 billion.
Strictly over $1.5 billion. I look at that $3 billion Apollo commitment as like a $3 billion gift card that you can only spend at the mega merger store.
That's a perfect analogy.
It's mezzanine-level rocket fuel. It is highly combustible, massively powerful capital, but you can only pump it into a heavy lift launch vehicle. You cannot put it in a Cessna.
Right. QXO cannot touch this $3 billion to acquire the $5 million independent roofing branches. They can only deploy it to acquire other massive, foundational companies worth at least $1.5 billion.
So it signals to the broader market that QXO is hunting apex predators, not just sweeping up the fragmented, localized dealers.
Exactly. They use the cash flow generated by the Beacon platform to absorb the smaller bolt-on acquisitions, while the Apollo capital is reserved exclusively for transformative, industry-altering mega mergers.
Now, the structural covenants of this Apollo agreement are a masterclass in corporate tax structuring and alignment of incentives.
They really are. The 50% beneficial holding requirement is a prime example of this.
How does that one work again?
Well, this covenant dictates that Apollo and its affiliates must maintain beneficial ownership of shares, either the Series C preferred stock or the common stock it converts into, that represent at least $400 million in initial stated value.
So it mathematically forces Apollo to remain deeply invested in the long-term execution of the buy-and-build strategy.
Right. It prevents them from simply funding the transaction and immediately exiting the position.
Which is smart. But the truly fascinating piece of financial engineering is the tax structuring buried in the 10K regarding Section 305 of the Internal Revenue Code. The agreement explicitly requires both QXO and Apollo to treat the newly issued preferred shares as common stock rather than preferred stock for tax purposes.
Which is a huge detail.
Yeah, I know from looking at leveraged buyouts that the IRS treats preferred stock very differently, specifically regarding constructive distributions. How does this specific structuring protect Apollo?
Okay, so Section 305 of the tax code governs the distribution of stock and stock rights. Typically, preferred stock that accrues dividends or features redemption premiums can trigger what's called disproportionate distribution under the code.
Right.
The IRS views the accruing value as a constructive dividend, which forces the holder Apollo, in this scenario, to recognize taxable income on phantom dividends.
Ah, so they would owe massive tax liabilities on income they haven't actually received in cash yet.
Exactly. By legally structuring these instruments and binding both parties to treat them as common stock, under this specific tax provision, they bypass the phantom taxable income generation.
Whoa!
It optimizes the tax efficiency of the investment, which is a critical requirement when you're deploying $3 billion of institutional capital.
So they are optimizing every single friction point, from the local branch supply chain right up to the federal tax code.
Everything is engineered.
So QXO has this highly engineered, tax-efficient $3 billion war chest from Apollo, and it requires a target valued at over $1.5 billion. And what exactly did QXO buy with this newfound capital leverage?
Well, just 1 month after finalizing the Apollo agreement, they deployed it. On February 10, 2026, QXO announced a definitive agreement to acquire Kodiak Building Partners for approximately $2.25 billion.
Which comfortably clears the $1.5 billion qualifying acquisition hurdle.
Very comfortably.
Yeah.
And it represents a massive strategic pivot beyond their core roofing footprint. Beacon provided the undisputed national leadership in roofing and exterior envelope materials.
Right.
Kodiak significantly diversifies the platform by injecting major operational capacity in high-growth adjacencies like lumber, highly specialized building materials, and, deeply entrenched local distribution networks.
They are aggressively expanding their footprint to capture a larger percentage of that $800 billion aggregate market.
Exactly.
But the structural execution of the Kodiak purchase is what warrants deep analysis, I think, because the $2.25 billion purchase price was not entirely cash.
No, it wasn't.
It comprises $2.0 billion in cash and 13.2 million common shares of QXO stock. Now, using equity as currency is standard practice to preserve cash reserves, but issuing 13 million new shares typically creates immediate friction with existing shareholders due to the massive dilution of their ownership stake.
Right. Dilution is the inherent risk of equity-funded M&A. However, QXO implemented an embedded call option strategy directly into the transaction architecture.
This part is wild.
QXO retained the absolute legal right to repurchase those 13.2 million shares from the Kodiak sellers at a fixed strike price of $40 per share.
Wait, really? So by capping the upside at $40, they are basically creating an insurance policy against their own future success.
That's exactly what it is.
If the execution of this $50 billion roadmap is flawless and the stock price appreciates to, say, $100 a share, the sellers of Kodiak don't see a dime of that specific upside.
QXO simply exercises the call option, buys the 13.2 million shares back at $40, and instantly retires them into the treasury.
So QXO's existing shareholders capture the entirety of that value spread, and they permanently prevent the massive future dilution.
It's a masterclass in capital management.
But why would the Kodiak sellers ever agree to a capped upside on the equity portion of their buyout? That seems crazy.
Well, the sellers accept the cap because the vast majority of their liquidity event, $2 billion, is guaranteed in cash up front. The equity component is secondary to them.
Okay. That makes sense.
And from QXO's perspective, it creates an asymmetrical risk profile that heavily favors their existing capital base. By issuing the 13.2 million shares at closing, QXO immediately preserves $528 million in cash, assuming that $40 valuation.
And if the macroeconomic environment deteriorates and the stock drops to $20,
then QXO simply lets the call option expire unexercised, and the sellers bear the equity loss.
wow. It is a highly sophisticated, deeply engineered methodology to utilize equity as immediate transaction currency while retaining absolute operational control over future dilution.
It perfectly aligns with the overarching architecture of the company. They used Beacon as the foundational anchor, they utilized Apollo's institutional weight to secure the mega merger dry powder, and they engineered the call option to execute the Kodiak integration without mortgaging the future upside of their existing investors.
But buying these companies is only half the battle. To hit their $50 billion target, they have to run them better than anyone else. All of this financial engineering, the Apollo warrants, the Kodiak call options, the Section 305 tax maneuvers, is ultimately useless if the delivery trucks don't run on time.
Absolutely. You cannot service a $2.25 billion bond with brilliant legal covenants. You have to generate actual cash flow.
Which brings us to the physical floor of these warehouses and the actual operational execution.
Right, because financial engineering secures the assets, but operational rigor dictates the margins. To hit a $50 billion revenue target, QXO must fundamentally redesign the operational mechanics of the distributors they acquire.
Right.
In the 10K, they explicitly state their mandate is to become the tech-enabled leader in the space. They are aggressively pushing into what is termed digital alpha.
Digital alpha.
Yes, the deployment of advanced technology to generate outsized nonlinear returns on physical assets. And at the core of this digital strategy is the deep integration of artificial intelligence.
Okay, we have to cut through the corporate buzzwords here because every company puts AI in their SEC filings right now to appease institutional tech investors. I want to know the actual on-the-ground mechanical application of this technology.
Fair enough.
How does a company apply Silicon Valley data science to the gritty physical logistics of moving heavy pallets of oriented strand board and commercial waterproofing membrane across the country?
What's fascinating here is the absolute specificity of their AI deployment. They aren't just saying AI will fix it. The sources outline highly targeted, revenue-driving applications that directly interface with the physical supply chain.
Okay, like what?
The first is lead generation. They are not relying on localized sales representatives driving through neighborhoods looking for construction sites.
Right, the old school way.
Exactly.
Yeah.
QXO utilizes AI-led solutions to actively scrape and model massive data sets, municipal construction permits, historical weather patterns, demographic shifts, and real estate equity data to identify highly probable new customer leads mathematically.
Long before their fragmented competitors even recognize the demand signal.
Precisely.
So the algorithm is actively parsing satellite weather data, cross-referencing it with the median age of the roofs in a specific Dallas zip code, and analyzing the home equity tap rates of those residents to automatically dispatch targeted marketing or direct sales outreach to local contractors.
Incredible.
That fundamentally changes the customer acquisition cost. But the second application, they detail pricing optimization that seems like the most aggressive margin driver.
Pricing optimization is where the sheer computational advantage of scale destroys the fragmented independent dealer. QXO is leveraging AI-led data analysis to calculate real-time price elasticity across their entire inventory.
Because in a traditional mom and pop shop, pricing is inherently intuitive and localized. A branch manager looks at their existing inventory, guesses what the local contractor will tolerate, and sets the margin.
Right, the branch manager says, well, I sold this bundle of architectural shingles for $30 last week. I'll try $32 this week. It's completely anecdotal. QXO's AI models bypass human intuition entirely. The algorithm analyzes millions of historical transaction records, real-time competitor pricing matrices, localized macroeconomic indicators, and supply chain constraints to calculate the absolute mathematically optimal price for every single SEC-CU in every single market, down to the hour.
Down to the hour.
It tests elasticity continuously. If we raise the price of this specific underlayment by 40 cents in Chicago, what is the exact statistical probability that the contractor defects to a competitor?
So it algorithmically maximizes the gross margin on every single transaction without sacrificing overall volume.
It squeezes every fraction of a cent of available profit out of the transaction.
And the third application, predictive inventory management, ties directly into that. The 10K details using AI-driven predictive analytics to forecast inventory accuracy down to the specific unit level.
Right. It's not just a regional manager predicting they will need more roofing materials in October because it usually rains.
No, the algorithm predicts exactly how many pallets of a specific color, specific brand, and specific grade of material will be demanded at a specific branch on a specific week, factoring in housing starts and upstream supply chain delays.
And that computational superiority translates directly into working capital efficiency, because the fragmented independent dealer guesses at their inventory based on historical trailing data. Consequently, they hold excessive safety stock of the wrong products, severely tying up their cash while simultaneously experiencing stockouts of the products contractors urgently need today.
Which is the worst case scenario in distribution.
Right. QXO displaces these independent dealers by guaranteeing inventory availability. They possess the exact product at the mathematically optimized price at the precise moment of demand. Furthermore, the 10K details their intention to implement zero-based budgeting, compress management layers, and deploy cutting-edge route optimization software for their delivery fleets.
And the physics of route optimization in this industry is incredibly complex. It's the classic traveling salesman problem, but applied to flatbed trucks carrying thousands of pounds of asymmetrical building materials.
It's not just delivering a small package.
No. The algorithm has to factor in the weight distribution on the axles, the sequence of the drop-offs at active construction sites, Department of Transportation hours of service regulations, and real-time traffic data, all to minimize the diesel consumed per mile driven.
It's a massive logistical puzzle.
But this reliance on a massive, centralized digital brain introduces a terrifying vulnerability, doesn't it? When you migrate 600 independent legacy AS400 systems and localized servers into a single AI-driven cloud architecture, doesn't that create a catastrophic single point of failure?
It absolutely does. And QXO's management explicitly acknowledges this systemic threat in the risk factors of the 10K.
I would hope so.
The aggressive adoption of centralized AI introduces massive cybersecurity vulnerabilities. Think about it. A ransomware attack on a localized independent roofing branch paralyzes commerce in one small town. But a sophisticated intrusion into QXO's centralized AI routing and inventory system could freeze the physical movement of building materials across half the North American continent.
Just gridlock.
Yeah.
And it isn't just external malicious actors. The 10K highlights the risk of AI hallucinations or fundamentally flawed algorithmic outputs.
Yes.
If the predictive model has a subtle flaw in how it processes historical weather data, or if an automatically execute purchase orders for $50 million of the wrong inventory right before peak construction season.
And by the time a human catches it, the purchase orders are already executed.
Exactly. The speed and scale that make the AI so incredibly profitable also ensure that its errors are amplified to a catastrophic level if they bypass human oversight.
This raises an important question about the ultimate limits of operational execution. You have a highly leveraged balance sheet, a massive M&A pipeline, and a supply chain entirely dependent on bleeding-edge data science.
Right.
The entire architecture relies on flawless execution, and that execution relies entirely on leadership.
So what does this all mean? We have an $800 billion defensive moat of an industry. We have aggressive, structured M&A funded by Apollo's institutional capital. We have algorithms dictating the price of shingles in real time. But it all ultimately hinges on the human element.
Always does.
The vision for QXO is steered by Brad Jacobs, the chairman and CEO. For those who don't follow the high-velocity roll-ups in logistics and rental industries, what is the significance of this specific individual?
Brad Jacobs is arguably the most critical component of the entire QXO thesis. He has a historically documented, highly successful track record of creating massive shareholder value by identifying fragmented, capital-intensive sectors and aggressively consolidating them.
He's done this before.
Oh, yeah. He was the foundational architect behind the massive roll-ups that created United Rentals in the equipment leasing space and XPO Logistics in the highly fragmented, less-than-truckload transportation sector.
Okay, so he's a specialist.
He utilizes a highly specific value creation playbook, deploying immense capital, enforcing rigorous technological standardization, and scaling revenue exponentially. QXO is essentially the exact same playbook, simply applied to a new fragmented ecosystem.
And he brings his established team of specialists from companies like Amazon and Barclays to execute the operational logistics and the financial engineering.
Right.
But the 10K specifically calls out his leadership as a material risk factor. It's classic pedigree risk. The entire strategy, the premium valuation of the stock, the willingness of Apollo to commit $3 billion, it is all inextricably linked to his personal track record.
That's the danger. The filings bluntly state that if he were to depart, or if his historical performance cannot be replicated in this specific industry, it poses the severe, immediate risk to the company's valuation. You are betting on the jockey just as heavily as you are betting on the horse.
And even a historically successful jockey faces macroeconomic realities that cannot be algorithmically optimized away. The building products industry, while heavily insulated by the non-discretionary repair market, remains cyclical.
It does.
Prolonged high interest rate environments severely depress existing home sales and new construction starts, which ultimately compresses the volume of materials moving through the branches. Furthermore, the cost of the materials themselves is highly volatile and tied to global commodities.
Right. Asphalt shingles represent the largest share of the products they distribute in the residential market. And asphalt is a direct petroleum byproduct.
So if geopolitical instability causes Brent crude prices to spike, QXO's foundational input costs skyrocket overnight.
Exactly. And the sources specifically highlight the severe threat of international trade friction. Tariffs and trade barriers represent a massive, uncontrollable risk to their margin profile.
Because they're importing materials.
Yes. If global trade wars result in steep tariffs on imported Canadian lumber or overseas steel and aluminum used in commercial construction, the cost of goods sold increases dramatically.
And while their AI pricing models will attempt to pass those costs onto the contractor, there is a limit to price elasticity. Eventually, the end consumer simply delays the project.
Right. Furthermore, if global supply chains fracture, domestic manufacturers might implement strict allocation protocols, prioritizing smaller local players over the massive aggregator simply to maintain market equilibrium, leaving QXO with less favorable volume terms.
Which means international trade policy directly impacts the margin on fixing a weather-damaged roof in Ohio.
It absolutely does.
But beyond the uncontrollable macro environment, the internal friction of this strategy is just monumental. Integrating companies of this magnitude is historically where roll-ups fail. You have to harmonize complex, massive organizations.
It's incredibly difficult.
You have to migrate entirely different ERP systems, reconcile wildly different compensation structures, and merge deeply entrenched corporate cultures. They have to seamlessly integrate the 600 legacy branches of Beacon and simultaneously absorb the massive network of Kodiak without ever disrupting the daily service to their 110,000 active customers.
It is the ultimate operational tightrope. Because you can build the most sophisticated AI pricing elasticity model in the world. But if the local branch manager quits because they despise the new centralized corporate culture, or if the delivery trucks sit idle in the yard because the legacy warehouse software cannot communicate with the new route optimization API, the contractor goes to the independent competitor down the street.
The $50 billion mandate is not merely about executing the financial engineering to acquire the assets. It is about the grueling, daily operational discipline required to not break the assets once you own them.
Well said.
So, whether you are an institutional investor parsing the debt covenants of this stock, a tech entrepreneur analyzing how predictive data science is applied to physical logistics at scale, or just a homeowner who will eventually have to pay a contractor for a roof repair, QXO's operational journey is going to fundamentally alter the pricing and efficiency of the built world around you.
It touches everyone.
Let's do a quick recap of this incredible architectural rebuild we've just unpacked. We watched QXO execute a total corporate metamorphosis. They operated as a $50 million software firm. In a single transaction in April 2025, they swallowed Beacon and emerged as a $10 billion industrial giant.
The anchor.
Right. They fortified their balance sheet with a $3 billion highly tax-efficient preferred stock vehicle from Apollo. They execute the Kodiak acquisition, utilizing a brilliant $40 call option to perfectly insulate their existing shareholders from equity dilution.
Masterclass in capital allocation.
They are deploying Silicon Valley data science to optimize SKUs and price elasticity in real time, mathematically displacing the local mom-and-pop shops. And it is all driven by the relentless Brad Jacobs consolidation playbook, with an absolute mandate to hit $50 billion in revenue over the next 10 years.
It is a breathtaking display of strategic financial ambition and operational redesign. But I want to leave you with a final thought to mull over, something that extends beyond the corporate filings and SEC disclosures we've analyzed today.
Okay, let's hear it.
Consider the ultimate endgame of this virtuous cycle of distribution consolidation. We explored how QXO's massive scale allows them to negotiate aggressive volume rebates for manufacturers and pass a fraction of those savings onto the consumer, utilizing their technological superiority to displace the inefficient, localized independent dealers.
Right. They bring algorithmic efficiency to a historically inefficient, fragmented supply chain.
But what happens to the ecosystem when the cycle is functionally complete? If QXO and perhaps 2 or 3 other mega aggregators successfully roll up the remaining 30% of those independent dealers, the fragmentation disappears.
It's just the big guys left.
Exactly. If the entire market is controlled by an oligopoly utilizing identical AI models to achieve perfect, mathematically optimized pricing elasticity, do those efficiency gains continue to benefit the end consumer? Or does this ultimate market consolidation eventually grant the aggregator monopolistic pricing power over the very contractors and homeowners this tech-enabled system was initially designed to serve? When the localized, inefficient competitor is entirely eradicated from the landscape, what market force compels the algorithm to ever lower the price?
That is a chilling and absolutely fascinating question. When extreme operational efficiency permanently eliminates the competition, does the efficiency ultimately only serve the aggregator? That is the $50 billion question we will be watching very closely over the next decade. Thank you for joining us on this deep dive into the mechanics of industry consolidation, risk defined, portfolio protected.